Welcome to our CFP Exam Prep podcast. Today, we're diving deep into tax rates, specifically focusing on ordinary income rates and the highest marginal rate of 37%. Understanding this topic is crucial for the CFP exam and your future practice. Let's break down the concept of ordinary income rates. Ordinary income includes wages, salaries, bonuses, commissions, and business income. The current tax system uses a progressive structure, meaning different portions of income are taxed at different rates. The 37% rate is the highest marginal rate. But remember that not all income is taxed at this rate due to the progressive nature of our tax system. A common mistake test takers make is assuming that all income is taxed at the highest rate when someone reaches that bracket. For example, if someone has taxable income of $600,000, they won't pay 37% on the entire amount. They'll only pay 37% on the portion exceeding the threshold for that bracket. Section 1245 recapture is particularly important and often appears on the exam. This refers to the depreciation recapture on personal property when it's sold for a gain. The recaptured amount is taxed as ordinary income at rates up to 37%, not at capital gains rates. Test takers frequently miss questions about this because they incorrectly apply capital gains rates to all gains on property sales. Short-term capital gains are another area where the 37% rate comes into play. These are gains from assets held for 1 year or less. Many students mistakenly apply the preferential long-term capital gains rates to all investment gains. Remember this key point. Short-term gains are taxed at ordinary income rates, which can go up to 37%, while long-term gains get preferential treatment. Here's a practical example that often appears on the exam. Consider a client who sells a piece of business equipment for $100,000. The original purchase price was $80,000, and they've taken $30,000 in depreciation. The total gain is $50,000. The depreciation recapture of $30,000 would be taxed at ordinary income rates up to 37%, while the remaining $20,000 could qualify for long-term capital gains rates if the holding period requirement is met. When studying for this section, focus on understanding the three main components where the 37% rate applies. First, regular ordinary income from sources like wages and business income. Second, Section 1245 depreciation recapture on personal property. Third, short-term capital gains from assets held 1 year or less. Another testing pitfall involves phase-outs and limitations. The exam might try to trick you by including scenarios where income levels affect deductions or credits. While the marginal rate might be 37%, the effective rate could be higher due to phase-outs of certain tax benefits at higher income levels. One final point to remember is that state taxes are separate from federal rates. The exam might include questions combining state and federal rates, so be careful not to confuse these when calculating total tax liability. This understanding of the 37% tax rate and its applications is fundamental for success on the CFP exam. Focus on recognizing when this rate applies and when it doesn't. Practice calculating tax liability using the progressive rate structure, and always watch for depreciation recapture situations in practice questions.